Systematic day traders routinely fail because they execute in an isolated vacuum. When you trade strictly off 5-minute price action without a macro boundary, you are navigating pure noise. This chart shows the exact problem and the solution. By applying the C-Wave umbrella framework and the DRW True C liquidity matrix, we impose a strict mathematical hierarchy over the chaos. This overarching boundary strips away the micro fluctuations. What remains is a clear view of true institutional bias, unclouded by retail panic. Building a sustainable algorithmic edge requires a dual-engine approach. You need a macro compass to dictate the direction of institutional capital and a micro trigger to execute the entry. Without this strict architectural hierarchy, execution is effectively just guessing against institutional order flow. We establish our macro compass by stripping the chart down and looking exclusively at the 1-hour timeframe. This is the structural foundation for every execution. This chart shows a 1-hour order block. The solid blue zone defines the boundaries of institutional interest. We cap the top with an aqua line, our buy-side anchor, and the bottom with a fuchsia line, our sell-side anchor. Right through the exact mathematical center of this block runs the mean threshold, marked by this dashed yellow line. This midline represents the true equilibrium of institutional volume for the entire block. This brings us to the first unbending rule of the matrix. The 1-hour mean threshold is the ultimate macro compass. As long as price respects this threshold, the initial macro trend, what we call wave A, is confirmed. Therefore, any lower timeframe execution is strictly prohibited unless it aligns perfectly with this 1-hour institutional equilibrium. Once the macro boundary is set, we shift focus down to the 5-minute execution timeframe to watch how price interacts with that limit. This diagram shows a common market sequence. An aggressive, deep price pullback driving directly into the 1-hour mean threshold. Retail traders routinely misinterpret this steep, aggressive momentum as a definitive trend reversal. By selling directly into an institutional block, they generate a massive pool of liquidity resting right on top of our equilibrium line. This exact sequence of events is the Wave B trap. This close-up view shows the primary structural rule for surviving the trap. Wicks do the damage, but bodies tell the story. The algorithms use long wicks to sweep liquidity and pierce the equilibrium, but a true structural shift requires a solid body closure firmly past the line. Profitability on these lower timeframes depends entirely on your ability to differentiate an institutional liquidity sweep from a genuine structural failure. You must identify the exact moment the Wave B trap is mathematically neutralized by incoming volume. This animated sequence shows the true C ignition algorithmic trigger. When the green triangle icon prints above the defending candlesticks, a localized dashed orange line extends horizontally. This specific visual print confirms the trap has absorbed the counter-trend volume. The trap is dead, and the true expansion, Wave C, is officially launching. This dictates a strict execution protocol. You anchor all limit orders directly to this newly generated 5-minute dashed orange midline. Institutional algorithms routinely force price to retest this local equilibrium. They verify the liquidity base before delivering a violent outward expansion. Disciplined system execution means you never chase the initial breakout. You secure your position by waiting for that localized micro retest. Immediately following the initial breakout, price will typically enter a brief, shallow consolidation phase. This forms a nested C, or a propulsion reload. It indicates institutions are stacking additional orders without offering a deep discount to the market. The optimal algorithmic scenario occurs when a primary ignition signal and a nested propulsion signal fires simultaneously on the exact same block. This chart highlights that dual signal event, known as the Super C. You see a green triangle and a blue NC badge side by side, their center lines sliding together to lock into one thick, glowing equilibrium line. This dual-engine alignment merges two independent liquidity levels into a single, highly fortified institutional price line. Because double institutional volume is concentrated in this exact block, the probability of price violating this level drops drastically, resulting in a zero slippage anchor. The Super C provides maximum execution conviction. The concentrated institutional volume minimizes the probability of a deep pullback, allowing you to enter at market with full confidence. To understand why these entries hold, we have to look at the underlying mathematics powering the triggers. Traditional static trading indicators rely on fixed look-back windows. They inherently fail the moment market volatility shifts. This graphic demonstrates the solution, the Kaufman Efficiency Ratio, or KER, dynamic look-back mechanism. Watch the numeric counter as the volatility curve steepens. It drops rapidly to 8. Then, as the wave flattens into chop, the counter expands to 48. By shrinking to 8 bars, the algorithm captures immediate momentum during expansions. By expanding to 48 bars, it effectively filters out false signals during consolidation. This image displays the built-in HUD panel. When a signal triggers, it reads your account size and risk percentage to automatically calculate precise contract payloads. An execution system is only as robust as its capacity to dynamically adapt its parameters to real-time market efficiency. This animated sequence traces the complete life cycle of a perfect execution. First, we verify the macro bias against the 1-hour mean threshold. Next, we wait out the Wave B trap by strictly monitoring the 5-minute candlestick body closures to ensure the level holds. Once the setup is confirmed by the algorithmic triggers, we drop the limit order squarely on the localized merged midlines. From that anchor, price expands outward, moving cleanly through the projected institutional target zones. The invalidation rule is absolute. If a single candle body closes past the active structural block, the setup is instantly voided. Before entering live markets, ensure your dynamic look-back settings are active and your wrist payload limits are properly configured in the HUD. A true algorithmic edge is achieved solely by binding macro institutional boundaries to dynamic, volatility-adjusted micro-triggers.